part of what we've done as a firm is we've taken the position that we want to be one of the foremost on opportunity zones nationwide. We have over 1,000 real estate operators and developers in our client base. That many of them are working potentially on opportunity zones that are seeking our advice. And so we're giving them a lot of advice on opportunity zone projects. We're helping them access capital in the capital markets on those projects. And then over here on the other side, we have all these clients where we know where all these capital gains exist. So I've never seen anything like it, where every day in my inbox, I have CPA partners around our firm that are filling up my inbox saying, I have this client that just took a $7 million capital gain. They want to know about op zones. I have this client who just sold 3 buildings for $25 million capital gain. They want to talk about opportunity zones. I've never seen this much interest. The amount of money, in fact, I have a quote here from Treasury Secretary Mnuchin that he believes there's going to be over $100 billion of investor capital that's going to flow into opportunity zone investments over the next few years. I think he's way light. In fact, when I talk to some of the smartest people in our industry, they think that this is probably going to be closer to $300 to $600 billion that's going to flow into this. I always said 1031 was the gift of the tax code. Opportunity zone, I think, is a way bigger gift than what the 1031 was. This is a really incredible opportunity for people to defer taxes, to get tax-free treatment, to do well by doing good. And that's the other thing about this. This is an opportunity for you all to have an opportunity to invest and do well and give back in your community and revitalize these areas, and also do well by making a very handsome return potentially on the investments you go into. So that's really unique with this opportunity zone deal. Again, what we're all about at our firm at CLA is we want to give our clients a good experience. There's going to be some bad experiences out there. So what we're doing is we're vetting these deals. We're working with the people that we've known for a long time that we trust, that are top shelf developers. We're developing funds and different products and vehicles for people to invest in. So we're really positioning ourselves to be, what we believe is, what we want to do again is provide deliver a great quality experience to investors, and really be the firm to help developers and investors on this. So with that, I'm going to turn over to Luke Pope. And again, Luke is with our firm in our real estate tax group, and he's been involved in consulting and advising a lot of developers and operators on their projects. He's been educating people in our firm on this topic. He's been a great resource to our firm, and he's going to talk more about the technical aspects, talk about what the tax benefits are of opportunity zones. So with that, Luke, I'll turn it over to you.
As Tony mentioned, my name is Luke Pope. I'm a principal in our real estate practice here in St. Louis, and also head up with a few other people our national practice in opportunity zones. Spent almost the last 15 years mainly consulting in real estate and tax area. And, I'd say in the last probably 8 to 10 years, have really gotten tax credits, incentives, new markets, historic tax credits. And then when this came out last year, we thought, hey, this is a huge fit, really kind of interplays with real estate as well as the tax credit piece, and so we jumped all over it. This program was created by the Tax Cuts and Jobs Act of 2017. When this bill came out last December of 17, I don't think anybody in the media even mentioned opportunity zones. Everybody was talking about the 199A, the 20% business deduction, talking about the rate shift, how just so many different provisions within the tax code. And I don't think one media outlet mentioned this at all. Well, January comes around, maybe a little bit more traction, but by spring, this opportunity zone piece was starting to get more and more press. And once more and more people learned about it, and we really started putting some pen to paper on how this program could really work, a lot of people in the tax credit industry as well as in the real estate space really thought, hey, this could be maybe one of the biggest provisions of the tax law change. And this could really be one of the biggest incentives that have ever passed in terms of, if you look back over the last 25 years at historics, new markets, this thing could generate more economic activity than any of those combined. Where did this really come from? So this was actually, there was a group called Economic Innovation Group that really wrote this code, and that was really sponsored by Sean Parker, who, he co-started Napster as well as Facebook. So this guy wasn't a real estate guy. I think originally this was meant for operating businesses, but the real estate market really latched on, and they were kind of the first adopters to this program. What does it what was the purpose of it? It was really formed to generate economic activity and job creation in these low-income communities. And I'll talk a little bit more about that later. But as Tony mentioned, there's a huge glut of capital gains sitting out there. I think at the time this was released, there was over $6 trillion just in the publicly traded market of unrealized capital gains that was sitting there to be unleashed to doing developments in these areas. So that doesn't even count all the private businesses that are out there, as well as other assets that could be capital gain potential. So the potential is really almost unlimited at this point. I don't think there's enough development in these zones that could capture all of the unrealized gain that's out there. So what are the benefits of this Opportunity Zone program? It's really threefold. So first, we have this deferral of capital gains. So, nobody likes to pay taxes, and so there's an opportunity to defer any type of capital gain. This is the first time, I think, in the history of the tax code that you could defer a capital gain from the sale of a publicly traded stock. A lot of people in this room are familiar with 1031 that Tony mentioned. If you sell real estate, you can defer that gain and roll it into another piece of real estate. Well, this has really allowed you to defer any capital gain and really roll it into any asset as long as it's in a qualified opportunity zone. The second piece is the reduction of that deferred gain over time. So let's go with an example. You sell your Amazon stock with $1 million gain, capital gain. You roll that capital gain into a fund. If you hold that fund for 5 years, that investment in that fund for 5 years, you get a 10% step up in that deferred gain. So now your $1 million capital gain is reduced to $900,000. If you hold that investment for 2 more years for a total of 7 years, you now get an additional 5% step up in that deferred gain. So now your $1 million gain is $850,000. So that's a nice benefit, right? You get to reduce your deferred gain over time. Unfortunately, I think it was a budgetary issue. The government didn't let you defer that gain indefinitely. So in 2026, you have to pay the tax on that capital gain. So $1 million gain, you have to pay tax on $850,000 of that gain in 2026. As of now, it's based on the capital gains rates at that time. So there's a little risk, right, that the capital gains rates increase over time. But we're hoping, with a lot of comment letters to Treasury, that we can get that so that it's the capital gain rates at the time that the asset was sold. So we'll see how that shakes out. Additionally, there's also been a request to extend that time out to 2033. So, if you look at the 2026 date, if you don't get the investment in by the end of 2019, you can't get a 7-year hold by 2026. So as you can see, there's a little bit of urgency on getting investments into these funds, since you lose 5% of that deferred gain step up if you invest after 2019. And then again, if you invest after 2021, you would lose that full, or you wouldn't get any step up in that deferred gain. So essentially, there's somewhat of an urgency to do that. However, once you look at some of the financial models or projections on some of these deals, you'll really find out that the true benefit really isn't in that step up in the deferred gain. It's really in this third piece, the permanent gain exclusion on your appreciation of your investment. So back to our $1 million example. So let's say we rolled our $1 million gain into a fund, and we hold that investment in that fund for 10 years. And then we sell that investment. Let's say we sell it for $5 million. That $4 million spread, if invested in one of these funds, has no tax on any of that appreciation. So that's where the real power of this investment is. On top of that, it doesn't appear today, and everything we're hearing from Treasury is that there won't be any depreciation recapture on that either. So if your $1 million investment, you depreciate that down to $500,000, you would have had a $4.5 million gain with the depreciation recapture as well. So now none of that will be subject to capital gains tax on exit. So really powerful program.